Mark, good morning. Much has been made about the Fed's impact on this market. However large it's been, you and your team at UBS think that it could go even higher.
Thank you, Brian. And I think that's right. You know, we've talked almost every month now since the crisis began. And it is true. We've said, look, you got to focus on the Fed here. And I think the question investors are asking is, okay, but, you know, what has changed that you can still be optimistic since the Fed's largest action took place several months ago? And what we would focus on is look at that 10-year yield. Despite the fact the markets have been rallying, since Chairman Powell spoke that he's not even thinking about raising rates, the 10 years remained very low. It hasn't moved, and the markets have continued to rally. And we think that shows that the markets are actually starting to believe that the Fed is going to hold these rates down, even if inflation were to creep up a little or asset prices continue to move higher. And that story isn't over yet.
When do you think it will be over?
Well, look, I think that's a great question. It's probably sometime when the inflation gets above the 2% target in a meaningful and sustained way. And based on what's happened since the financial crisis and the fact that we have not sustainably hit that 2% target, that could be some way off.
Given that backdrop, Mark, and given that the Fed, to your point, is still in play for a while, when you look out, what do you see then as the possible greatest downside risks to the market? We had a guest on yesterday, Lee Baker of Apex Financial. We laid out all these scenarios, and he said a severely contested election in November might be his greatest downside risk. What's yours?
Well, I think that, that is certainly a downside risk. The politics around not just the election, but the need for passing, the fiscal plan and the budget. These are all things that can play into the near-term picture. But I think that, to derail the larger story of what the Fed is doing on the monetary side, and directionally, the fact that who's ever elected, that both sides have plans for infrastructure and other fiscal measures, you don't want to get too caught up in the politics around the election. And, of course, as you know, no matter what happens, there will be a president sworn in January per the Constitution.
Where are you and your team finding value in this market, which we just laid out, 37th record high, 16th record high? Is there any part of the U.S. equity market, Mark, that still looks like it is fairly or even undervalued?
Well, as you highlighted, some of the more cyclical things got a little bit of a boost yesterday as some of the news might be getting better. And I think to the extent that trend about lower hospitalizations in the United States, continued economic recovery, to the extent that that persists, I think we would look more towards the industrials and also towards healthcare, and then some of the consumer discretionary can also benefit from that recovery. And then I think getting back to the points around the election, I think one of the things, should the current polls continue in the direction that the Democrats may pick up influence out on the other side of the election, we're continuing to find investors around the world, even ones who are just focused purely on their portfolios, are looking at this green recovery, looking more at sustainable investing, because they're saying, what are the sectors, where is the money moving towards? Is it a more sustainable use of energy and other things? So that is something that our clients are really focused on.